Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so we're going to talk about is a report that came out from the senior economist and director of forecasting for the National Association of Realtors, Nadia Evangelou. Here's her picture and some information. Okay, so what she did was she looked at interest rates over the last 6 weeks, the trend, and talked about forward-looking things for forecasting to provide information to the professional realtors out there to give them more information for their business for next year.
Right, and for educating buyers, sure.
Sure, and for educating buyers, because the thing everyone always wants to know is now a time to buy, right? Mm-hmm. Which is sort of it's a difficult question because 2011 was a great time to buy. You should have bought 20 houses then, right? You would have tripled your money. Okay.
Right.
Okay, so what we're going to do is we're going to go through the article and we're going to talk about the specific things in the article. Before we do that, though, if you're new to the channel, subscribe, notification bell, like the video, share the video. If you're not new to the channel, put in some comments about what you think interest rates potentially are going to do next year and what you're going to do next year.
Right.
What are you going to do next year with real estate?
Oh, I was going to say, you're going to Disneyland?
No, don't go to Disneyland. Save your money for real estate investment, okay? You're wasting your money at Disneyland. It's super expensive, and the rides aren't that fun, okay? Tell your kid you buy him a house instead of take him to Disneyland, and they can get rental income.
There you go. So actually, speaking of that, not related to this video in particular, but I want to know, how many of you have actually done that, have actually purchased a house for your child, adult child in particular, whether it's your adult child for them to live in because they're starting out in life, or for your adult child as their college property, and then you ended up either keeping it as rental or selling it when your child was done with college. I always think it's interesting how we deal with that as far as helping our children. So tell us your story. I'd love to hear it.
Okay, that's interesting. That we'll talk about that, I think, at the end, because that's an interesting, there's an arbitrage thing in there as far as what's a better use of your money, paying rent or buying, and even for a short period of time, which is, it's 4 years, but it could be 6 or 8, depending if you have multiple kids attend the same college. Okay, so we're just going to jump into the first part of the article here. So mortgage rates dropped even further this week. According to Freddie Mac, the 30-year fixed mortgage rate decreased to 6.27% from 7.086 weeks ago. That's a substantial decline. As a result, homeownership has become nearly 10% more affordable in the last 6 weeks as the monthly payment decreased to $2,140 for the median price home. To a couple things here. This is huge news. Because normally when interest rates go up, they go up potentially 18 months. It's the longest they've ever gone up, mortgage rates. And they peaked already, and they've already gone back down.
Right. So what I think is interesting about this is that, so homes are 10% more affordable. Now, I want you to focus on that 10% because everybody likes the 10% number. It's a sexy number, and we can all kind of wrap our heads around that. So homes are 10% more affordable. Let me think about this. So from the peak in June to, October, November, homes maybe went down about 7% in list price.
7%.
But interest rates didn't move 7%. But now in a matter of 6 weeks, homes are 10% more affordable. Does that mean that homes are 10% more expensive because interest rates went down? Why isn't that all working in the same way?
Yeah, no kidding.
Okay, so this makes a really good point, because those people who believe that interest rates and home prices, that there's like a seesaw effect, you can see that it isn't. It doesn't really work that way. Interest rates, to a large extent, are completely divergent from home prices, okay? Home prices are going to do what they're going to do against supply and demand and against other factors, and interest rates are really a function of monetary policy trying to influence homes, but it's not a seesaw effect.
The other thing, too, that's interesting in the quote, we did a video on this a few days ago, like I think we did Christmas Eve or the day before. There's zero economists are predicting a return to 7% rates. So let's talk about this, Juana, because we're going to go into the next quote after this. We already know the Fed has said on the next meeting, January 29th, that their intent is to raise rates 0.5%, half a percent. The federal funds target rate right now is 4.25 to 4.5. They're likely to go to 4.75 to 5. This is the rate at which banks lend money overnight to member Federal Reserve banks. But doesn't that, so people, when I have discussions with people, they go, well, interest rates are going up. But that's not mortgage rates.
Correct.
Okay,
So,
tell them about how that works. Because that's counterintuitive. People think the Federal Reserve like orders people to charge a certain rate.
No. Okay, so there are lots of different interest rates out there because, you see that your car interest rate is different than your credit card interest rate is different than your mortgage rate is different. And so there are all kinds of interest rates. So, just because the interest rate that the Fed is raising the basis for as far as the amount of interest that banks charge each other to borrow money overnight, that's not necessarily going to have a huge impact on mortgage rates because mortgage rates are looking at the long term. Remember, they're not loaning you a mortgage overnight. They're loaning you a mortgage for 15 years, 30 years, a really long period of time. And so a lot of these numbers have already been baked in. And so we know that because Jerome Powell has actually been very good about signaling what his long-term intentions are for raising the federal funds rate. The Mortgage Bankers Association is very keen on this, and they have kind of figured out where they want to be. And so what they've already baked in all of this, and so they're looking at long-term mortgage rates for borrowers over the long term, and they also have to be competitive with one another. So that they want to go ahead and they want to loan money at a competitive rate where people will borrow. And they also understand that the current interest rate environment is very short-lived. Interest rates will go down in the relatively near future, particularly when you're judging the future against your long-term mortgage. So because of that, they're saying, hey, we're going to maybe make a little bit less in interest from you in the first year, maybe 2 years, but in the long term, we're going to make more money and interest from you. Not only that, but remember when you're borrowing money on the front end, you're charged all kinds of lovely fees, and that helps to cover all of these costs too for them. So the mortgage brokers are making money. Don't worry about them. They're doing all right. And the fact that they're not making as much in interest on the front end is okay because they've got it all factored in for the duration of the loan.
Okay. The next part of the article is eye-opening. It's eye-opening, okay? With mortgage rates double those a year ago, home sale activities declined significantly compared to the previous year. We've been talking about this for months. If you compare it year to year, it looks bad. However, this year's activity is only 4% lower than the historical average, 4%. That's literally not even within the margin of error. It's negligible. About 4.9 million homes are usually sold during January, November of each year. This year, about 4.7 million homes were sold during those same months. So the idea that the home prices, that the mortgage rates would go up, would choke off home sales didn't happen. So what two things? Okay, let's talk about two classes of people. Class one, cash buyers. How did the mortgage interest rates affect them?
So they don't. That's the short answer.
Okay.
Or if they do in the sense that they're choosing to not borrow money or not borrow, and then just choosing to use cash rather than borrow money because that's a better use of their money.
Okay. So there are people probably getting loans that could have paid cash, but they want to use their cash for other things.
Right.
Now they're like, I want to add assets to my portfolio. I want to add real estate. I'll just go buy another house or buy some rental houses. We'll just pay cash instead of getting loans.
Well, the other thing is, I mean, anybody who's paying attention to the stock market this year, the stock market has not done its best this year. The
NASDAQ is down like 34%.
Right. So, so people are taking some money off the table there, and maybe they're putting it somewhere else, maybe in real estate, to try to protect their cash the because it's not doing well in the stock market. The the inflation is eating up the value of their cash. So maybe real estate is a good way for them to park their cash. And maybe, when interest rates go back down, maybe they'll choose to refinance, pull cash out, and do something else with it. But at the moment, a lot of people are parking cash in real estate.
Okay, let's talk about the other people getting loans. And we're going to go very granular on this. The the neighborhood you always wanted to live in, the homes last year were selling for $420. Right now, you can get the house for $375. So it's down. It's down a bit, okay? But interest rates are kind of high. I mean, if you bought the house 2 or 3 years ago, you got a much lower rate. So what's the strategy? Like, what are people doing? Let's say that 6.25% number, right? You're going to get a loan for 6.25%. Let's say you're income qualified and you can do it. What is the thought for the future? Like, what are people potentially going to do? They get that 6% loan now, but the home is much cheaper than it was if they bought it in the spring.
Right.
So what's their plan? Like, what are they going to do you think?
Well, if it was me, I would, if it's the right house for me in the right place, I need a place to live. I'd rather put my money against a mortgage than paying the landlord's mortgage payment.
Okay.
So I'd rather pay my mortgage payment rather than someone else's, so I would buy the house. But that's me.
Okay, then what happens let's say in 2 or 3 years, mortgage rates drop back down and they're 3.5%.
Woohoo! I get to refinance.
You refi, and now you just dump all that high mortgage debt, right? Okay, here's the interesting thing. We did this on a previous video. The percentage of total people servicing mortgage debt to disposable total income, it's 4%.
Right.
It's 4%. This means all disposable income in the U.S. and all people paying mortgage debt, it's 4%. It's very little.
Right, because nearly 40% isn't paying a mortgage at all. And out of the 60% remaining, most of those have reasonably low mortgage payments because they either have low balances, have low interest rates, combination thereof. So they put a lot of down payment down. Maybe they refinance when the mortgage rates are really low to get their payments down. So a lot of those moving parts. But the bottom line is, when you're looking at the totality of people, so remember, not you, not your neighbor, but the totality of people, we're looking at 4%. So an example is, for example, if I own my house free and clear, and he's using 30% of his income to pay his mortgage, then our combined would be 15%. But I own it free and clear, he uses 30%. The person next door to me is also free and clear. Now all of a sudden it's, goes down to between the three of us 10% and so on. So, yeah. But when you're looking at the totality, that's how they came up with that 4%.
And remember that the number's only really 30%. Like usually when you buy the house, because it's the total number of percentage of debt, your payment you're servicing. And what tends to happen over time is disposable incomes go up. Right. It's just like when I was a kid, we bought a house where our payment was $350 a month in Las Vegas. And I remember my parents were making about $1,000 a month between them. And I said, hey, that's really, I told my dad, I said, isn't that, because I was like 10, I said, isn't that that's like really expensive? Is that how it is for everybody? And he goes, yeah, but he said that there was inflation. This was in the 70s. There's inflation, and we actually we're getting these 7 to 10% pay raises every year. So next year we're going to make another $100, $200 a month. So, but that payment will never change because that $350 will always pay that. So over time, our income. He explained this to me when I was 10. Our income will go up, and that $350 will be actually less real money. And that's when I first understood this idea of nominal versus real dollars. Right.
And this is why it's really important to understand the benefit of making your own mortgage payment versus making your landlord's mortgage payment. Because your mortgage payment is probably fixed, and the amount of rent that you're paying is never fixed because generally there are annual increases to your rent. So that's something to consider. A good way for you to control your costs is to have fixed costs, and the largest expense for most people is housing. And so if you can fix that cost, then that helps you in other areas of your life.
the next quote from the article, unless inflation surprises with an upswing, mortgage rates will move closer to 6%, which is a decrease from the 6.27 that they are now, at the beginning of next year. Now, this article just came out, so when she says the beginning of next year, it's like a week from now, bringing more buyers back to the market. So we have two things happening. We have interest rates going down despite whatever the Federal Reserve is doing, because the mortgage market is looking mostly at inflation, not really at what the Federal Reserve is doing. They're looking at inflation, which is substantially improving pretty rapidly, except for energy, which is, there are other factors affecting that right now. And then we have the affordability is 10%. So we have more people coming. We have homes that are more affordable. We still have all the cash buyers. We have declining inventory.
Right.
We have decline. It's already declining. Inventory is declining. So this idea that inventory, and we peaked in inventory here in Las Vegas October 21st. It's declining.
Right. I was going to say inventory has been declining for the last 2 months.
Yeah. So I think, I don't know nationally. Well, we know nationally it's declining because when we got the end of October numbers, it had already started down. So we know it's declining into November. In a couple months, we'll have the November and December national numbers. And I think what we're going to see is we're going to go into February and March with the complete cessation of declining list prices of real estate. And then it's going to get very interesting in March, April, May, June, with when we get back to this market. If interest rates stay at 6% or even go down to 5%, Freddie Mac said already, Freddie or Fannie said they predicted by the end of the year they'd be 4.5%.
Right.
Which is pretty. I think that'd be incredible if that happened. I don't think they're going to get that low. I think they're going to end up in the 5s, like the mid 5s.
I agree with you. I think they're going to be in the upper 5s, but yes, I think
Yeah.
they're going to be pretty close to 6, somewhere between 5 3/4 and 6 and change. I think is where it's going to be. But remember, interest rates are determined by a lot of things, including your credit score, including how much down payment you're putting down. So lots of different variables. So they are different for everyone. They are particular to your situation.
The other thing too is people have talked about, well, they say, Todd, what about this recession? I heard it's going to be really bad. First of all, bring on the recession, because I've been hearing about the recession as much as I've been hearing about the housing market crash, which hasn't happened. And so the thing with the recession is people's payments are so low compared to what they could rent. Like if you lose your job, you're not just going to say, well, as a cost-saving measure, let's get out of this really expensive $1,100 a month house payment that we're making, and let's go rent a house where it's going to be $2,200 a month so we can save some money because homeownership is so expensive. Let's just go be renters. It's not like literally the last thing you would do. So the thought that there would be massive job losses, and I think the predictions, because right now the unemployment rate's like 3.6 or 3.7, I think they're talking about it going all the way to 3.9%.
Well, the other thing is, and so I respectfully disagree with you. I think that, a recession is probably more likely than not. We've just been through a lot and we're still going through a lot.
Oh, no, I'm not saying it's not going to happen.
But,
yeah.
I just don't see unemployment numbers spiking sufficiently to severely impact the housing market. And if unemployment numbers do spike to that point, the government has been stepping in at every turn, every time anything has even hiccuped. So the idea that the government wouldn't step in and say, hey, you know what, if you've had a job loss, then, mortgage banker, work with these people and do some sort of abatement, give them some sort of a break. And remember, even if you're looking to sell your house, you have equity in your house. So regardless of what the rental market is out there, even if you go to sell your house, you will probably put some money in your pocket. So it's not like people are upside down in these houses. Almost everybody has equity, and not just a little bit, but quite a bit of equity. Even people who bought at the beginning of 2022 have equity. They have equity for two reasons. One, because they had to put money down, so that's equity. Because remember, most people were putting down quite a bit of money. And two, there is, values in a lot of markets are still higher today than they were in January of 2022. So between those two, there is equity. So people are not in a position where they're in a negative situation where they owe more for the house than what the house is worth.
Right. And then the other thing too to keep in mind is that, 40% of the housing market is free and clear. You have all these people who bought their houses a couple years ago. The people I feel bad for are the people who sold in 2020, beginning of 2021, because the housing crash was getting ready to happen and home prices just went up. And they're probably up 30% from there. They would have to, and they've been renting this whole time. And we know some people that did. They sold the house, and that's fine. That's what they wanted to do because they thought they wanted to protect themselves. But, I would not be surprised. I honestly would be surprised if we finished 2023 with substantially lower prices than we have right now. I wouldn't be surprised if they stayed the same or went up a little. I don't think a recession, like Wanda said, is going to be that big of a deal because whatever job losses happen are going to be, I think, pretty minor. I think just because the economy doesn't grow, because it shrinks a bit, a lot of the reason it's going to shrink is because a lot of companies that were going to expand and grow may not do that. But there are companies I know for sure, there are industries that are outperforming. Remember, because the recession doesn't mean every company shrinks and every company gets rid of people. Some industries will do extremely well. Tourism is doing incredibly well right now because we had 2 years of very little tourism, and now everyone's, has the money they've saved for travel is going into travel. So if you've been on an airplane, it doesn't feel like we're getting ready to go into recession. You see these, the flights are all full, and the tickets are, relatively expensive. So there'll certainly be certain companies where businesses back off on spending, or they get rid of. Some tech companies have already done this ahead of time. They've cut back some people, but it's not. It doesn't look like it's affecting housing that much. No, because everyone still has to have a place to live, and the housing market's super tight right now.
Right. And just because some businesses are contracting doesn't mean that others are not expanding or that new businesses are not being started. So particularly, this happens quite a bit when there is a contraction in the economy. A lot of times you have these people that have vision, right? They have something they've always wanted to do, and this is an opportunity for them to branch out on their own and start a new business. And those are good things. Those are opportunities. And, that is going to be something that's going to come out of this as well.
Yeah, I think the most interesting thing about the article is that this idea that affordability, because everyone's been saying, homes are the least affordable they've been in a long time for two reasons. Home prices are really high, and then mortgage rates. And those are both true things, but wages are the highest they've ever been. Okay, that's one. Unemployment's the lowest it's ever been. That's two. Interest rates are kind of high too, but the NASDAQ has lost 34% year to date, and it's a terrible year if you invested in crypto. You got completely wrecked, and there's a lot of people with a lot of cash still that are looking for deals. And right now, there's rental vacancy. The rental vacancy rate is the lowest it's literally ever been measured, and the homeowner vacancy rate is the lowest it's ever been since the
1978.
78, the last time it was as low as it is. So all the houses are occupied. All the rental houses are occupied except for the natural people moving and then somebody else moving in. The housing market's still really tight. Mm-hmm. The stuff we've seen is all a normal market. In the fall, more homes come on the market. Home and list prices tend to drop. Happens every single year. The last video, we talked about that. This is normal market. I'm just calling it right now. It's a normal market. Housing has clearly performed very well the last couple years. 2022, whatever prices hit, a lot of that was inflationary and a lot of that was froth. So when somebody says the market's crashed, and I go, how are they crashed when it's more than they were a year ago and 30% more than it was 3 years ago? How is that terrible? So I don't know. Obviously, we're bullish on housing. We did not sell any rental houses. Mm-mm. And the investors that we've worked with that have told us when they're ready to sell, of course, and this is a large number of people and number of houses, have all said, no, we're not selling. Literally, we have had a couple people sell that have had to sell or want to sell.
Right. So, the only people that we've had sell are people who had relocation issues and that sort of thing, but not anybody who was just moving across town sort of thing.
Right, yeah. Actually, that's interesting. Real estate agents in the past, what used to happen was people would sell their house and then they would buy another house in a different part of town or a nicer house, right? They would upgrade because they had some kids or whatever. And the reason why they didn't keep the other house was because interest rates were 6.5%, 7%, 8%. And you couldn't afford to keep a house because rents were less than your home payment, right? And you couldn't afford to keep the house and then get a loan for the next house. Like the banks wouldn't lend you money because you had too much out of pocket on the first house. That's actually flipped around now because most people have super low interest rates. So when they're buying that second house, they're keeping the first one as a rental because they have a 2.5% interest rate. And they're like, I'm just going to rent it out and I'm not going to sell it. I don't need the cash to go to the next house.
Right.
I'm just going to sell it, pocket the rent, and then get the next house on a loan. So when you look at the national number, and we did this on the last video for the last 5 years, there's the fewest number of homes on the market now that have ever been on the market because the two sides are not happening. The people aren't selling and buying, they're only buying.
Right.
So we have an inordinate number of buyers, and that's what we saw the last 2 years. More buyers than sellers created disequilibrium, prices went up. Short-term interest rates caused this normal cycle to be a little exaggerated, which you can go back to our videos in May and June, and we absolutely said this is what was going to happen. Short-term interest rates would go up. It would exacerbate the cycle. And then what would happen in the spring is we'd go back to a normal cycle. And we already have the data. It's already happening.
Right.
We can see it happening.
So we know that this is not a market crash video. It's not a sexy video about some dramatic thing happening, that we're telling you it's a normal market. Sorry, it's a normal market, guys. So if you found the video interesting or entertaining, please like the video, share the video, subscribe, hit the notification bell. Tell us what you think about the market. Tell us your prediction for the spring. We'd love to know. If you're new to the channel, tell us where you're watching from. And we appreciate you being here. Please be nice to one another in the comments, and we'll see you on the next video. Bye.
Bye.